Okay, investors, we're going to talk about stagflation this week. What, where, why, and how it can affect your investment portfolio. First off, what is stagflation? Let's go ahead and define it. First, the economic textbook term, then the real world and investor world term. Textbook economic definition, stagflation is a combination of high inflation and slowing, or worse off, negative economic growth. Most of the time you have rising unemployment, which can create a breakdown of the normal economic cycle where inflation and recession occurs together. In the real world, in the consumer and investors world, prices for essential things like food, energy, and insurance keep rising while wages, job opportunities, and wages versus cost lag, creating a squeeze on consumer spending, leading to a decline in real wages. So where stagflation is showing up today, the top three regions: Europe, especially Germany and the UK. Why? Because, well, Europe spent decades outsourcing their energy independent to Russia and others in favor of more expensive and less reliable clean energy sources. Now, energy shocks from both Russia-Ukraine war and Iran-Israel war are driving up energy costs and making their sources less reliable. Exactly when their higher regulation hurts both growth, weak industrial output, and lost market share to China. So the second place we have some deflation, China. Property crisis and its outright deflation, which is now in its 15th year, continues to contribute to weak consumer demand. The deflationary pressures of many trading partners reshoring production, combined with too many labor workers, are mixing with the inflationary effects of higher energy and higher healthcare costs. Third and finally, think of emerging markets like Turkey and Argentina. Chronic inflation caused by currency flight over decades continues to be paired with unstable growth and policy missteps. As for the United States, here's where we sit. Sticky product inflation caused by tariffs, reshoring manufacturing, and higher commodity import costs. As far as growth, we are currently accelerating in GDP growth in the second and third quarters after a first quarter slowdown. AI CapEx spend has largely been the reason for the continued strength in the U.S. economy versus most other countries. However, given the weakening labor market on a dollar per job basis, as well as higher costs, the odds of stagflation here in the U.S. are increasing for 2027. Third and finally, why stagflation exists in these regions? Generally, 5 major reasons: energy dependence and supply shocks. Many countries outsource their energy security and dependence. The Russian conflict exposed this vulnerability and caused an inflation spike. Another area, overregulation and weak productivity growth. Heavily regulated and socialized economies continue to struggle to generate real GDP growth. Think of structural stagnation. Another reason, globalization reversals. Reshoring over the last 5 years is increasing cost. Supply chains are shifting away from China, causing higher costs, less efficiency. Another area, debt overhangs and policy constraints. High government debt limits versus GDP limits government stimulus. You can't easily stimulate growth without worsening inflation. Another and final cause, currency rate weakness. Think of Japan and emerging markets. Weak currencies import inflation via higher commodity prices. Many investors look to gold as their inflation proxy. I look at gold as a currency depreciation proxy. If you think gold has risen in dollar terms, look at it in yen terms from Japan or euro terms from the continent, or worse, in the currency of an emerging market like Turkey or Argentina. Currencies are relative market games. Finally, what's the impact to your investments on stagflation? Who are the winners and losers? Remember, this is historically, there are no guarantees of future returns. So the winners historically, energy and commodities, which benefit directly from inflation pressures. Companies that hold hard asset inventory win as their inventory gets priced higher with inflation. Another area, utilities and infrastructure. Companies with long-term, hard-to-obsolete assets, the halo complex tends to retain pricing power combined with stable demand. You probably won't shut off your water or electrical utility if you have a choice. Dividend growth stocks. Income does matter when growth is scarce, so long as a company can, 1, raise prices to cover costs, 2, grow units marginally. You are generally safe there. But beware of companies with 100% pricing gains and units shrinking. That is usually a license for a bad stock. Tips in short-term bonds are usually good areas for investing. Inflation-protected treasuries readjust their coupon with inflation, so they're a better hedge than straight-up treasuries for inflation protection risks. The losers, those historically challenged, long duration, slow, or no growth stocks. Higher rates compress valuations there. No revenue stocks usually don't work out well as they act like zero coupon bonds. Consumer discretionary, spending weakens as real incomes relative to inflation fall. Long-term bonds are usually a bad investment. Inflation erodes real returns. Long-term yield rise, so bond prices fall. You would want to own shorter duration bonds, which mature, and then you can repurchase at higher yields in shorter maturities. Another area, higher leverage companies usually don't help your portfolio. Rising interest costs and weak unit growth are horrible inputs for larger leveraged companies. Higher interest costs mean cash goes to pay bondholders before shareholders. What was the famous saying? When asked, how did you go bankrupt? The answer was, slowly at first, then all at once. You don't want to be near any company who's near a tipping point on their debt load. So what's the portfolio takeaway in a stagflation outlook? Shift towards a barbell with true growth combined with real assets with pricing power and reduce exposure to interest rate sensitive slow growth and long duration risks. Investors, stagflation is not just an economic turn, it's a portfolio regime shift. The playback moves from aggressive growth, risk, and expansion to stable compound growth, asset preservation, and resilience. Investors, we all know it's tough to walk. So what do you do in a turbulent geopolitical time like now? What's it best? It's best that you stay focused on what matters to stocks over time. What's that? It's earnings and earnings growth rates, and they aren't just important right now, they're everything. For now, stay disciplined and stay diversified and focus on what's real, not what's just exciting. Whether your priority is growth, income, or a combination of both, the Oak Harvest team is here to help you plan for your financial future, no matter where you're at in your career or in your retirement journey.